Hey, everybody, it's Jeff here once again with the Money Trekker podcast, and I'm here with my friend Tom Kemler today. We're going to be talking a lot about the economics and what's going on in the markets today, really giving you an update on where the economy is moving after, in Texas and most of the country. We had an incredibly cold week last week. We had snowpocalypse down here in Texas, and we kind of lost track of where all the economics was. So we're going to go back to that today. And Tom has also got a couple of really fun and most interesting things for the day. So stay tuned. We'll be right back on here in a minute. Hey, everybody. Welcome to the Money Trekker podcast. And I'm on here with my friend, Tom Kemler. Tom, how are you doing today?
Tremendous, Jeff. A lot better than a week ago today.
Absolutely. I'm with you. And I know you live where there's a bunch of trees that are not trees much anymore. So
yeah, it's terrible. I love trees. I think every investor should either love trees or understand trees because they have a lot in common with growing your portfolio. But yeah, I got a guy coming out here to help me tomorrow. That ever since things started to thaw, you've heard nothing but chainsaws and chipper shredders going all the time in my neighborhood.
Yeah, it's a shame. I mean, and a lot of old oak trees and stuff like that we lost during this time period. So
yeah,
I'm hoping. I was looking at 2 or 3 of my oaks in the backyard, and the leaves are already all brown. I'm like, okay, well, hopefully they bud out and fall off. And
yeah, I've never seen live oaks do that, and
yeah,
not many people have. So that's going to be really, it's going to be interesting to see. Then I'd had oak wilt. I think I'd mentioned to you. So I've been on a planting spree for the last going on 15 years now, and some of those trees are starting to get pretty big, but they're still not, in this climate it's hard to grow a tree very fast. And and I just don't know whether they made it or not. Just whether they had the gravitas to make it through.
Yeah, absolutely. Well, I mean, we've never seen anything like this in history. So, I mean, I think the last time anything like this happened was like in the late 40s. So it's, it's those things that happen. It's the wonderful world of climate, and it changes all the time. So what I wanted to kick off today real quick is to quickly just talk to the audience a little bit, to learn a little bit about you and talk about your role with BK Wealth. First off, just learn a little bit about you. Tom, how did you start your career? What did you do? All that kind of good stuff.
I started to get interested in finance when I was in high school, really. My dad would get a subscription to the Wall Street Journal for some reason. He was an engineer, and he knew I was interested, so he would bring it home for me. So I was kind of reading the journal just from him, and then I went to Delaware and got an economics degree, and then coming out of college, I got a job with Merrill Lynch as a not broker. They didn't want us to use the term broker. I think they had, at the time, this was in the 80s, they had just coined the term financial consultant, and so that's what my business cards read.
Yeah.
From there I went. I was not a very great salesman. In fact, pretty poor. So, I ended up. I wanted to get into the analysis and more of the behind the scenes thought process rather than the out front delivery of financial services. And so I ended up going to Nations Bank, as it was called at the time, and then became Bank of America, and worked in their trust department for a while. Then I came down to Austin, worked with a money management firm. Along the way, I got my CFA and did a little bit on my own for a while, and then hooked up with you guys in 2019.
Yeah. So you are the BKA's chief business appraiser. So talk a little bit about what you do on a daily basis, working with clients.
We do business appraisals. We have 3 levels. We've got, a deep dive. We've got, something that's fairly rigorous as a middle option. And then we've got kind of a light version that will give an entrepreneur or a business owner just kind of a general idea, if they want to get the conversation started on something like a transaction or what have you. The deeper dives we do, is fairness opinions, or for estate valuations, or gift purposes, something that's rigorous, that would stand up if need be.
So when you're doing business valuations, what are some of the common things that affect people's the value of their business? Just advice for business owners of some things that you see that cause them to not have as much value.
Well, that's a tough question. I don't think there's every situation is different. That's probably the main thing that I would see, is that every business is different. Every business owner is different. Some business owners are very clinical and very dispassionate about value when looking at things, and then there are some business owners that are emotionally tied in and think their value should be A, and if it's not A and it's B, then they're real disappointed. So I can't say that there's one thing that, other than just the tremendous difference from industry to industry and from person to person. Each situation's unique. And I like to think, at least, from my perspective, I've always kind of been a jack of all trades. And so that serves me well in a situation like this, where I don't have, one way of doing things, that I'm pretty pliable in trying to understand the nuances and individual characteristics of a new situation or a different situation, and come at it from kind of a bottom up, instead of imposing what I think ought to be looked at from the top down.
Nice. So how would you say, now what you do on the appraisal side, how would you say that kind of leads into other stuff that we do at BK Wealth?
It leads into it, and we have developed relationships. But I want to stress that that when we do business valuations, you're not going to hear me talking about a lead into other things. That's we don't want it to appear that way. It's a standalone situation, and anybody who's thinking about a business valuation shouldn't be thinking that, well, then I'm on the hook for hearing these guys talk about, it's, if you end up liking what we do for you in the valuation, we can certainly open the door to other things. But I would definitely stress that, first and foremost, you hired us to do a business valuation. That's all we're going to talk about.
Yeah. But I think, there's always those opportunities too. I think of a couple of cases we've all worked together where, originally it was a valuation for one purpose, and then in the end, it turns out that it was a valuation that they decided to sell the company, and, needed the help to figure out how the heck to get out of it at that point, and how to make that sale, and how to move on into the next portion of their life. So I think it's been fun
Oh, it is. It
to
is.
really help a lot of folks.
Yeah, that was definitely, but that was them asking us,
Yeah.
And that's the thing that I would want to stress is that it's nice when somebody asks and says, well, hey, now that I think I'm going to do this, can we take the next step, and we can do that together. But
Yep.
I definitely I put myself in the person who's getting the valuation done, and I'm saying, it's kind of like going into the store and having somebody come up to you and, no thanks, I'm just looking, I don't want to hear about anything else other than what I asked for in the beginning.
So you're like going into a department store with perfume snipers coming after you from every direction.
So I just, it's one of those deals where, we'll talk about business valuation, and we'll do as deep a dive and get into as much nuance as possible. And then, as you were mentioning with those other steps, if those other steps get taken, then then we can certainly open up. But it's not anything that we're going to be, it's not going to interfere at all with the initial process.
Yeah.
And
Absolutely. Well, that's the important part first, is let's establish a value, and then let's figure out a pathway for you on what you want to do going forward with that. Well, good. So let's talk a little bit about what you've put together for us this week on the economics. And, we've always got lots of good, cool charts. So why don't you take charge and tell us a little bit about what's going on?
Will do. One thing I was going to do, which, let's see, we'll do this one first. Because we've had kind of an interesting couple of days, but just to kind of segue, one of the things that I have found in business valuations that is a bit of a head scratcher, and so a lot of people in the business valuation community are CPAs, and I don't think I'm not saying there's anything wrong with that. I'm not a CPA, I'm a CFA. And as a CFA, I am in tune with what the equity markets are doing on the public side. And I've seen in our practice where I think that there's a certain element of the business valuation community that has these formulas in mind that, oh, we'll put a cap rate of X on it, and they come towards values that are really divorced from what's happening in the public markets. And I don't think that's the right way to go. I mean, I think that private valuations of smaller companies are not going to march in lockstep with what's happening with the S&P or the Dow, but you have to understand, broadly speaking, how value in equities is going to percolate through to everything. And so, you can't just have a formula that says, oh, well, and I think there is an element in the business valuation community that approaches things that way. And so to the extent that we differentiate ourselves, it's partly because, I have a keen view of what's happening in the stock and bond markets that are driving real equity values, and that has implications at the edges for private valuations. So, with that being said, we can start to take a look at this week's. We're going to start off with our. I hope you can still see our usual inconvenient truth,
reassuring lie. Yes.
This may be the last week for that. I just I feel like we have to start off with something every week that's a little bit funny, and this one has just kind of struck me. So once again, I feel like we're the guys that are going to be in the inconvenient truth theater, and hopefully we'll lure over some people. So let's talk about, we had just talked on Tuesday, and even though it's only been 2.5 days, not even 3 full days, um, a lot of news has come out, and one of the things that has struck me, especially since we started 2021, and I said, I'm not going to put up a lot of reports that are going to be hitting the consensus. I want to focus specifically on the out of consensus reports.
Yeah.
Well, it seems like virtually every report is out of consensus. I mean, we are getting bombs on both sides, that, and mostly to the upside. So things are things are a lot more volatile, and you're seeing some of that in the way the markets have acted in the 3 days that we since we spoke. We had a huge up day on Wednesday. The Dow actually went over 32,000 late in the afternoon on Wednesday, and now here we are down almost 1,000 points in the 2 days since, and it's not even really newsworthy anymore. So,
Yeah.
um, so let's start out with new home sales. The new home sales number was a monster, and the prior number was revised upwards by 842 to 885. If you do the math there, that's about a 5% revision upward, which is pretty substantial. And then the actual number came in on top of the revised upward, blew out the consensus range, and came in at 923. Very strong. And we'll talk more about the real estate market, because it's to me, it's driving almost everything in the economy right now. Retail inventories, we've been talking about this a lot during the summer. When they were going down, they were being drawn down, and retailers were not replenishing. And in fact, even after we did our show on Tuesday, I saw the Wall Street Journal had an article on Tuesday about how suppliers are struggling to get product into stores, even despite the fact that the retailers are now ordering it. It's more running into a situation of everything from supply constraints because of COVID, supply constraints because everybody else is making stuff. Definitely enjoy seeing the financial media getting on a story months after we talked about it. But the retail inventories number was one that was very thin all summer long, started to plump up in the fall. And then what we saw is, as we got into January, was that we were starting to see inventories build. And for those who are just joining us, you would look at an inventory number and you'd say, well, geez, if inventories are rising, isn't that bad? And in a more normal environment, yes, it would be bad. But we had such a drawdown last year that we needed to replenish inventories to get back towards some sense of normalcy. And we've been doing that. But then here in January, we reversed that, and reversed it pretty dramatically, from a 1.9% inventory build to a 0.6% draw. So it still shows that and this is also related to that blowout retail sales number that we had earlier in the week, where if you recall, that retail sales number was huge.
Yeah.
Wholesale inventories have been doing kind of the opposite. And so this was a case where the prior inventory was pretty, inventory build was pretty small. And then we had a pretty big inventory build at the wholesale level for January. So you pair that with retail drawing down, it may just be a case where wholesale hasn't handed off to retail yet. So you can see some of the sequencing, almost the the pig moving through the anaconda, if you will.
Thank you for that image.
Yeah, sorry. I mean, just a jungle. uh, anyhow, I thought I'd put the State Street Investor Confidence Index on because this is one thing that I find interesting. This is not a survey like a lot of when you see confidence, a lot of cases, what that is, they're just asking people, how confident are you? You go into the small print here, and I'll just paraphrase it. Is that what this really does? Is it looks at institutional investors and says, how are you positioned? If you have a lot of equity exposure, you're more optimistic. If you have less and you have a lot of bond exposure, you're less confident. So in the past, in February here, when compared to January, this is a big pullback. This is about 10% from essentially 101 to 92. So a lot of people were pulling into bonds, which when we talk about bonds in a little bit, is kind of an interesting twist. Durable goods. Now, this is kind of, it's not completely related. I mean, this is everything from Boeing aircraft to locomotives to wash machines, all sorts of big ticket items. These have been going gangbusters, and this number was a blowout. If you look at the prior number, they basically revised up the prior number by a full percent across the board. And then the number still blew out the consensus by a huge amount. So we'll do a deeper dive. This is durable goods orders over the last 6 years. And one of the things that you notice right away is that, and mostly it's because of how valuable aircraft are, and it depends on when aircraft are delivered, that you get this ping pong back and forth between positive and negative, positive and negative. And so that's kind of the normal cadence for durable goods. Well, look at this. We've had 9 straight months now, ever since the COVID March and April of last year, 9 straight months of increases in durable goods. And not only that, we've gotten back above the level where we were going into the COVID pullback. This is another case here. This shows where the prior peaks were before COVID. And then this is the prior peak overall. This peak up here in 2018. I think that scale looks a little different from chart to chart, but anyway, they're basically saying
back where it was. Yeah,
we've not only this is the COVID down and the COVID bounce and the rebound, and now we're not just back to where we were back to highs. And so this is not only this is so strong that you have to start thinking. I'm not saying this yet because it's not in the data, but you have to start thinking when you see this of like, okay, how much further can this go? We're not there, but I'm just saying that this and home, this is a lot of this is driven by the home situation, and the home sales are kind of similar. Are we at a point where we've had such a strong run that maybe it's time for a bit of a pullback? And I thought this was very interesting. Pending home sales index, the prior number was revised higher, but then this month's number came in much poorer than expected, down almost 3%. So something, it is a hiccup, and this is for January. So this doesn't include any of the crazy February weather. So that's just something to think about. Kansas City Fed, we've been doing these these manufacturing indexes. We looked at Empire State and Philly, and they're all very strong. Again, that's partly driven um, by the durable goods and the home building. Have a few charts in here from Moody's because interest rates are going to be something we're going to talk about, that I find interesting. This was the first recession since 1982, all the way back here. These green lines are defaults, corporate bond defaults. And the high yield default rate got at least to 10% in these shaded bars here are recessions. And you can see that you get into a recession, high yield is companies that are not as credit worthy. So you can see that the incidences of bankruptcies would spike uh, pretty high. And yet, look at this. This is what's happened with this recession. Just a little bit of a liftoff. That's kind of part of the normal wiggles that you see from year to year. Mm-hmm. This is also a kind of a busy chart, but I'll show you this. This is home sales on a 3-month average. This includes new and existing homes put together. So you can see that existing home sales have been around 6.5 million. We just saw new home sales at 923,000. You add the two together, you're at around 7.5 million. You can see the COVID drop down and then the huge rebound. I mean, the massive, we've gone in less than a year, we've gone from little over a 5 million annual rate to 7.5. That's a 50% increase in the pace of the entire home real estate market in less than a year. It's a huge, this is a 10-year chart, but a move like this would be awesome on a 50-year chart. Mm-hmm. So this is to my mind what has been driving all of the strength in the economy because of how important home sales are.
Yeah.
And you can see here that it's starting to drag treasury yields up. The treasury yields are things that the markets are starting to get worried about. It's something you and I have been talking about for 6 months. We started talking about it down here as we were seeing this take off. And what this chart really purports to show is that you see this decline in home sales here in 2013 and 14, and then again in 17 and 18, and it presages interest rates falling. A little bit later, you have a peak here, and it goes down and it pulls interest rates down. Peak here, down to here, and it helps pull rates down. So to the extent that the equity markets are starting to get concerned about bond rates, you're going to need to see this modulate. Now you can see this little hook on the top. That's a little bit of what we talked about in the last slide, but it's way too early to say that this thing is peaked. Although when you have such a massive move like this in a mature industry, you could probably make a case that it could level off, but we just don't know because there's so many unique and novel variables in the current environment, including the fact that after the Senate parliamentarian made the ruling, everybody's expecting another $2 trillion log to get tossed on the fire here in about 2 weeks. So last but not least, this is also kind of a similar chart. This is except in this case, they put the treasury yields in the gold, and they've got the industrial metals in the green. And the industrial metals are somewhat related to the home building. I mean, you think about how much copper goes into a new home between pipes and air conditioning. So the industrial metals index is as high as it's been in over 10 years. And you can see that it's pulling the treasury yields along with it. And it's basically the same case as this one. It's saying that in order to cool down the treasury yields, these metals indexes would have to pull in. So I think before we go to Oh, this is
Yeah,
the end.
which is going to be a challenge just for the simple fact that with the amount of building that's going on, you're going to, especially on the copper side, you're going to have significant demand for a while until that slows down.
Yeah, and you also get into the situation, and it happens. I mean, you were asking me earlier about, when I remember even as a kid hearing about like Chilean copper miners going on strike in the 70s.
Yeah.
You get a copper bull market, and all of a sudden I'm hearing about Chilean copper miners going on strike. So um, it's happening.
Yeah.
But I mean, that's the thing. You get into a situation where the market starts to overheat, and there's a lot of different players in every market, and some of them say, hey, what about me?
Mm.
You're making a lot of money. Copper prices have about doubled in the past year or so. What about me? And the workers say, so these are things that are all part of every economic boom and bust. um, and that's just a part of the industrial metal scene. um, I will, but as a segue to go over to the Wall Street Journal a little bit, we were talking about 10-year yields, and we're seeing how um, the yield on the 10-year Treasury has been creeping higher ever since we made the call. I think it was in August. It was like right around here. I know we didn't get the bottom, but we were close.
Mm.
And so we've been seeing it march higher. Um, this is the dividend yield has been usually stock dividend yields for many years have been lower than treasury bond yields.
Mm-hmm.
People own stocks not just for the dividends; they expect some price appreciation also. But in cases like beginning in really early 2020, even before this is the COVID, the panic in COVID drove yields down, and it drove stocks down, which meant it drove dividend yields up. It made owning stocks that much more compelling, which was another reason why we were saying, hey, stocks aren't looking that horrible. Well, they've been closing the gap, and now just like right now, they are crossing over.
Mm-hmm.
This is 147.50, um, and right now the 10-year Treasury is 144.7,
Mm-hmm.
and it's pulled back. We yesterday got to 155,
Mm-hmm.
and we've pulled back a full 10 basis points. Now, when you and I did the show on Tuesday, we
Yeah.
were at 1.35. I think it was right around this part of the day, late Tuesday afternoon. So it's been an amazing 3 days in the Treasury market since. I mean, you had Treasury yields rise about 20 basis points from Tuesday to Thursday.
Mm-hmm.
That's a big move in any environment, but it's especially a huge move when you're talking about you're starting at 1.35 and you go to 1.55. I mean, think about it. The magnitude of a 20 in a 135 to 155 range is that's a huge move. That's um, 7-8%, or no, more than 10%. So one thing that this is the last trading day of the month, and this is we've been talking about people that have a ton of treasuries and bond related instruments in their portfolios. They might get a bit of a shock depending on how many stocks they have when they look at their statements for February, because um, when yields go up, prices go down. That's just the way bonds are priced. And so when your statement is looking, if you have bond funds, bond ETFs, or outright bonds, individual bonds themselves, they're going to be priced as the bond instrument and not on yield. And so when yields have gone up and the value of the bonds has gone down because of the yields going up, you can see a material difference in a month like February. Especially, you look here, this is a 1 month chart, which shows you that at the end of January, the 10-year treasury was just over 1%, 1.06. So it's had a 40 basis point move in a month. Now, it's an exercise that if you're looking at your statement and you see, what kind of instruments do I really own? The two things to remember when you own bonds, and I'm not going to get into duration and convexity and all these technical terms, but I would ask every bond investor to remember the two L's, low and long.
Mhm.
Now, if you have a low coupon and a long duration, so in other words, like the standard here would be a zero coupon 30-year treasury. They
Yeah.
exist. The price impact is going to be the most maximal on the low and long. If you get away from low and long and you're, short term and high coupon, the price differences aren't as dramatic because there's just not that much time horizon before the bond matures for it to change value that much, and you're getting um, a cushion from the coupon. But there are a lot of very low, since we've been in a low interest rate environment for really going back to the uh, great financial crisis in 2008. There are a lot, trillions of dollars of instruments that with really low coupons that still have really long maturities.
Yeah.
And they are going to capture a month like this in a negative way. One particular one to look at, this is the Lehman Brothers, what used to be the old Lehman Brothers. I still call it that. I'm sorry. This this is iShares.
Yeah.
This is the iShares for the month has gone from 152 to 142, and
Mm.
that's a 20-year Treasury ETF.
Yeah.
So 10 points on 152 is about 7%.
Mhm.
So if you had this ETF in your portfolio, you've seen it go down 7% this month,
Mhm.
and that's a tough month, and
Yeah.
that's with it going up 2.5% today.
Yeah. Yeah.
Um,
Just a little bit of a recovery today.
yeah, it was looking like 10% yesterday when it was down at 138.
Well, I mean, I think we had this conversation on the show earlier this week of, talking to my mortgage guys, and I mean, they've seen a dramatic pop in the mortgage rates too, and what's, usually that follows along with the 10-year, but the other piece of it is, they've extended the moratorium on foreclosures. And so what that has done is pushed, a lot of the mortgage markets going, hey, whoa, we've got to price in the fact that we may not be able to foreclose on some of these houses.
Yeah, I just put up the MBA mortgage applications number.
There
They
you
put this is MBA Mortgage Bankers Association. They put this number out every Wednesday.
Yeah.
They've got a composite index, they got a purchase index, and a refinance index. And you can see these numbers are huge to the negative. The
Yeah.
composite index was down 5%. These numbers, this is usually kind of like durable goods. Week to week, it ping pongs, but yeah, look at this week.
Yeah.
Huge.
Huge down draw. I mean, you got to figure too, if you're seeing a big spike in mortgage rates and you've seen this huge spike in house prices, I mean, you got to look at affordability at this point.
Yeah, I mean, so
And is that going to bring the market back down a little bit on the real estate side?
well, that's been the thinking over just the last 24 hours after, it was a Nomura Securities guy. I don't know what his name was, but he had kind of circled 1.5% on the 10-year as a level for everybody to start tearing their hair out.
Mm.
And yesterday, without getting into the minutia of it, apparently there was a 7-year treasury bond auction that went pretty poorly yesterday.
Yeah.
And that pushed rates up. That was what pushed it over to 155, and got to 155. The Dow's down 600. It was officially everybody light their hair on fire day.
Yeah.
And we're having some follow through today.
Mm.
And then, but it's not, it's a lot of this is interest rates, and we're going to stick with the fundamentals. But I gotta take this opportunity right now to talk about, we saw the resurgence of GameStop this week.
The thing that won't die.
It's now I'll say this, when we first talked about GameStop, we talked about it at the end of last month.
Yep.
And I made the call that the January 27th closing high, which I think was 357. I said that's going to be the high. It's not going to get taken out, and it hasn't been. But the next day in the pre-market, there was reports of the stock trading over $500 a share. The highest tick I've seen is 480.
Yeah,
but
it looks like 483 on the 52 week.
Yeah, the 5-day, if you look here, before it started to take off, it was around, it was in the low 40s. This is Tuesday. Call it $43 a share. So if you go from, I'm going to say 400 to call it 480, whatever. It's over 90% down in less than a month. So as much noise as it made up on the way up, and then all of a sudden you have congressional hearings, and the thing really let a lot of air out. There's some conflicting reasons as to why this happened. I don't know if they just tried to get the band back together. I mean, there was some talk about they had fired their CFO and hired a new one, but that had occurred a full day earlier, and there had actually been some discussion that was a negative. So why it took off in the last hour of Wednesday isn't a surprise. And I don't necessarily want to talk about GameStop in the sense of it being just a place for people to go and play chicken, which is really what it's become.
Yeah.
But its effect on the markets, and it's twofold. The first is, when these guys get going, it had a visible effect on major brokerage firms this week. Schwab, TD Ameritrade, E-Trade, Robinhood, of course, and a number of the big brokers. You just, if you had to call a brokerage firm for some reason, you were going to be waiting, up to an hour, you just to talk to somebody. If you were executing online, you may have had some trouble, and I'm sure a lot of people out there can corroborate that, because I was reading about it. So that's factor number one. It's just it's this rockin' party that is so loud that it affects everybody else's concentration, if that's the way to put it. You're in the apartment next door, you're not even at the party, but it's still affecting you. Second effect that it has, and this is a direct effect, is that what happened in January scared the daylights out of the hedge funds and the shorts. It was a short squeeze of unbelievable proportions. It was the theoretical becoming reality. And I'd been, talking earlier going back to when I was studying for the Series 7 and my early days at Merrill Lynch in the 80s, you would hear about, theoretically what could happen in a short squeeze, but you never saw it until GameStop last month. I mean, there was the Volkswagen thing in 2008, which, so I'll say
Well, I mean,
this.
I think I was listening yesterday to the financial news when I was driving over to our other office, and I think at that time, I think it was what 140% of the float of the stock was shorted. Now
Last
it's
month,
down to
yeah.
like 30%. So yeah, the hedge funds got stung pretty hard, and they're a little bit more judicious, I think, with their shorting, and you know,
Oh yeah, the short interest has cratered in GameStop. And that's one of the reasons. Once the short interest gets low enough, then nobody's pressured to buy it, and that's the thing that makes a short squeeze is how many people need to buy it, and you keep pushing that price up by buying it in front of them, and then they keep thinking, oh, should I cover here? And you just chase it up. And um, but what it does do is it's cost hedge funds billions of dollars,
yep,
and and it's also cost them in terms of like they don't necessarily now want to initiate positions like this. And so and if GameStop gets going again like it did, it's going to cause them to pull their horns in, because one of the other things that happened in GameStop in January was that all the brokers got, with a need for collateral because of all of the minutia involved in closing trades, it caused everybody to have to post more money and want to step away from risk. And when you step away from risk, you're selling, and you're selling and raising cash. You got to post more collateral. You want to take your risk down. You move, from a stock position into cash. And when the market does that in aggregate, you can help exacerbate and gives you moves like what we're seeing in the Dow Jones in the last couple of days, or the Nasdaq's bouncing back today, but it had a really rough day yesterday, and didn't do that well on Wednesday. Um, so GameStop has had this effect of not only um, crowding out and creating noise that affects other participants just in trying to trade, but also it's affecting the markets in that you could have hedge funds that are unloading stocks that are completely unrelated just because they need to raise cash, because
mm,
they don't want to be they don't want to be in front of this ramp, like the stock going from the 40s to 177 in
yeah,
24 hours. It's
yeah.
quadrupled. um, and then you look at this huge move from here from 40 to 480. There's the 347.50, 347.51. I called it that day, said that it would never get higher. I'm sticking with that. Um,
Drop the
so
mic.
I'm surprised that we got this bump, but
Yeah,
especially with the when it was 140% short, that was just a recipe for a conflagration.
mm,
Right now with it 20-30% short, it's just not there's not the potential.
yeah. It's funny because there's one site that I follow that has basically high short interest stocks on it, and I'm looking at it right now. GameStop leads the pack at 41.22% short interest. So I mean that's a drastic difference, and I mean there is nothing out there of all stocks on NYSE or anywhere that are greater than 41.22 right now. So that says that the high flying days of some of these hedge funds of pushing the floats up above 100% and all that are just, I think they're all playing it a lot closer to the vest now.
Absolutely. Yeah. No, yeah. I mean, and they're saying so. They're like, first of all, I still don't know how you do it.
I,
Um,
I don't either. It's like
I
it
thought
doesn't
there were
make sense.
rules that
Yeah.
you had to have it hypothecated, and I didn't think that a share could be lent more than once. So how there is leverage on that, I still don't really get. But I mean, it appears like it's kosher. except what it really was it was like everybody went to one side of the boat and were surprised when the boat tipped over.
Yeah.
You have to also consider who else is, who else is on the trade with you. And if everybody does the same thing, then you're set up for a reversal. And
Yeah.
that's exactly what happened.
A bunch of little guys just got on the other side of the boat and just kind of barely pushed it, and boom, the whole thing came tumbling down on top of them.
Now, one thing I just say about those websites, and I look at them too. Now, just as a caveat, the short interest is only posted once a month officially on the exchange, NASDAQ, on the NYSE or whatever. There are a lot of sophisticated websites that keep track of things that purport to dive in and analyze the trading every day to understand exactly where the short interest is on a day by day, minute by minute basis. And I don't know how accurate they are. They are different. You cited the site that you were talking about that said 41%. I looked at a site this morning that had the number around 30%.
Yeah.
So there's definitely, especially in a stock that's trading like this one, there's I think 74 million shares outstanding in GameStop, and
It's
traded
turning them
for
over
85
every
million.
day.
So in a situation like that, it's really tough to slice the salami on each trade and figure out who's covering and who's not. But the bottom line is that I'll give those guys their due. I'm sure that they're not wrong in direction. They could be wrong in magnitude, but suffice it to say that GameStop's leverage in terms of short interest has come down in a big way.
Yeah.
So all this being said, I was going to segue back to a couple of the most interesting things as we end this week. The first was, I'm just gonna. This is kind of a COVID statement. For those people who remember the movie Spinal Tap, or This Is Spinal Tap, and they had the scene where they were playing in these pods on stage with smoke. The only thing we're missing here is the smoke from the pods. So
yes.
But this is how you have to play in a high school band in the world of COVID. If you're in a school,
the glass half full, half empty. Half full is that they actually are able to be in the same room and play. Half empty is they have to look idiotic in a pod. So,
actually, I would say 2/3 full because they're actually at school.
That's true.
They're in a school where they're and actually the school published this picture. This is from Washington State, and the school's proud of this. The school's like, hey, we're
here. Hey,
we're here and we're doing stuff in person, but still, I just this may be an iconic picture of the United States if it were put in a time capsule. And then the most interesting thing that I thought was, as we come to the end here, is I saw this headline and I had to do a double take. I was like, "Are you kidding me?" As I remember Al Jazeera buying Al Gore's, and I think didn't people call it like Al Gazura? I don't seem to remember that, but anyway, Al Jazeera bought Al Gore's television network back about 2013 or so, and tried running a left-leaning channel that was losing money, and they shut it down after just a couple of years. And so it's kind of interesting to me. This would almost be, you could scratch out Al Jazeera and put in New York Times or Washington Post. I don't know how this is going to work. They've hired, they're going to call it Rightly, which is an interesting name, led by a former Fox News journalist. I don't know who that is, and I'm not on top of guys that are behind the scenes.
Apparently, it is Scott Norville, a former Fox News staffer, will be the editor-in-chief.
Yeah, I don't. Yeah, I mean, editors. I just they're kind of never appear, so I don't really know them. I mean,
Yeah.
people in the inside baseball, inside media, they all know each other, I'm sure. But this is going to be interesting. I find it just from a markets perspective, um, that say what you will about the media, and everybody's got an opinion in this hyper partisan environment, but even people on the left understand that almost all of the media is liberal, and so there is this idea that there are a lot of people. If everybody's serving just half of the population, that there is a business opportunity to service the other half, and so these guys are just being businessmen and saying, hey, let's try and do it.
Yep.
I don't know if they're going to strike the right chords. I don't know whether they're going to come across as being sincere enough for an audience to say, yeah, I like these guys.
No, I think it's
It's
yeah, it would be key for them to just get personalities. I mean, yeah, I think, I look at some of these channels both on the left and right that pop up, and I mean, the real challenge is getting the personalities on there that attract people to the channel. And you look at like the Newsmaxes and some of those, and I mean, yeah, they may be a little bit more right leaning, but I mean, they just don't have the personalities on there that people are interested in even watching. Because it still in some ways is entertainment. It's news, but it's also entertainment, and you've got to have that power of the personality to bring an audience in.
Well, that's true. But you also, with Al Jazeera, at least, now you're getting into, it's a Persian Gulf monarchy.
Mm-hmm.
It is the Al Thani family of Qatar,
Yeah.
and so um, it was always felt like their true politics, if you want to call it that, with their regular Al Jazeera brand and the Al Jazeera in America brand, was that they're left to center, and you're talking about a guy who's an absolute ruler of a kingdom. He's not used to editorial discretion or stepping aside. So I mean, I just don't know how the top down ownership is going to allow statements that may be not cool for their point of view.
Yeah.
um it's going to be an interesting thing, and but one thing's for sure, that the Emir of Qatar and Al Jazeera both have a ton of money, and they will spread it around. They will get the personalities you're talking about, and they'll pay for whatever distribution that they need to get on to cable systems, satellite systems, what have you, and be in a position to have eyeballs drawn on them. So, um, if they're really behind it, it's going to be an interesting thing, because I've just wondered, especially where a lot of people, on the conservative side, had been watching Fox News over the past year or so. I mean, it was um, it was not a surprise or a secret. Everybody from Donald Trump on down was wondering why Fox News was trending to the left and hiring people like Donna Brazile and firing people like Lou Dobbs and uh, Trish Regan. So there's been this move where, for most people, there was like Fox News served people on the right,
Yeah.
and everybody else served the left.
Yeah.
And then for some reason, Fox News said, we're going to go over here. I mean, creates a vacuum. Somebody's going to fill it.
He's gonna step in. Yeah. I mean, and like I said, if you've got the funding for it, like like an Al Jazeera has, I mean, maybe they can pull it off. Like I said, I agree with you though, that, how much editorial, freedom are they going to have at that case of, if they say something against, the Middle Eastern countries, is that going to get shut down or just not allowed to be put on the air?
Or get you executed.
Well, that too. Yeah. I mean,
they do that.
They just take you out.
Yeah. So there is that. But I see we're in the closing minutes of the month, and we've really tailed off here. Just in the last few minutes, the Dow is down about 200 points.
Yeah. Everybody's selling out right before the end of the month to make their numbers look good on the reports.
And you're also seeing in a case like, and I should have mentioned this earlier, the big winners, we saw it with the way that the Treasury market worked. Stuff that had been down all month was rallying today, and the stuff that was up strong was selling off. And so you have that end of the month, people taking profits, or vice versa. But I don't know if there's kind of an interesting straight down tail there. Dow ended up down 475 after being, it was, we'll say, looks like it lost about 300 points in the last 15 minutes. Wow. Make sure there's no news coming across that that may have been just stuff that was
just end of the month. Everything's closing out. There wasn't any major options expirations or anything this week, was there?
No, I think there's more. Now options have gotten so liquid, and there's so many. There's daily options, there's weekly options. The monthly options are still the most liquid, deep markets, and they expire on the third Friday of the month. So
that's just that. It's just everybody dressing up their portfolios before the end of the month, and
it is. And
Monday we start anew.
So
excellent. Well, thanks, Tom. We appreciate it. Good as always. I thank you for sharing the pod people in Washington. So I'm going to take the glass as half full, and according to you, 2/3 full, that they're back in school and they're actually able to interact with each other. So that's a good thing.
They are.
All right. Well, folks, thank you so much for being on the show or watching the show again. We are on all the major podcast networks, but especially on Apple Podcasts, Google Podcasts. We're on Rumble. We are on YouTube. So however you want to watch us, we're out there. Make sure you subscribe to whatever channel you like so that you know when things are coming up. I've done a couple of extra podcasts over the last couple of weeks that are under our specials. So you would not know unless you're a subscriber that you see some of those. And there have been some fun ones where we're doing some interviews and then talking about other things related to money and topics and things like that. Coming up on next Wednesday's show, we're going to have another member of the BKA team, Kelly Freeman, who's going to be talking about college savings and college planning and college finance. She's actually going through this right now with her daughter. So it's a mother's approach to this and a financial advisor's approach to it. So please join in. I think you'll enjoy it immensely. So thanks a lot. We'll see you back here next time.
Before we go, I'm going to speak on behalf of myself, since I don't know how to do these things. And maybe somebody else could. But if I want to go to, say, Rumble,
yes,
and I just put Rumble into my browser and I get there, what do I have to do to find what we? You're going to
type Money Trekker into there, TREKKER, and it will come up that way.
So it's the Money Trekker. You got to search for that.
Yeah, 2Ks.
Okay.
All right, folks. So thanks a lot, Tom, and we'll see you guys back here later.